Good afternoon, and thank you all for joining us for the 2021 Africa Real Estate Outlook webinar brought to you by API Events. We have an excellent panel and discussion lined up for today with some of the leading figures in African real estate. The objective of this webinar, which is our first webinar of the year from an API Events perspective, is to really set the scene for the continent's property market in 2021 and really get an understanding and feeling as to where we headed from an industry perspective after a very, very difficult 12 months, both on the continent and obviously globally. We have a very exclusive panel today from the likes of CDC UK, Standard Bank, Grit, Morif, as well as JLL. So really diverse panel, which will provide real insights into and perspectives into what developers, investors, and practitioners are looking at from an Africa real estate perspective in 2021. Before we start the session, I would just like to highlight a couple of things that API are doing this year. We're going to be rolling out our regional summits in the latter half of the year, so starting in July, where we'll host our EAPI Summit, September, our API Summit, and our WAPI Summit in November, among various other things. We're also doing a real estate as a service event called Real Estate Experience, which will focus on all operational real estate assets. That will be taking place in May and it will happen virtually. The rest of the summits will happen in a hybrid format. So yeah, we're very much looking forward to jumpstarting and kickstarting this year, and we hope this session really provides a great outlook for that. So without taking too much more time, I'm going to hand over to our moderator for the day, Tom Mundy. He will do a brief presentation, just overlooking some of the macro elements, and then introduce the panel. We'll then have a full panel discussion and then also engage in audience questions. So please feel free to send through your questions, and we'll have a look at those and hopefully tackle as many as we can. So excellent, have an excellent one, and thank you for tuning in.
Great, thanks, Kafir. I think the presentation should come up on the screens, which I've provided. Maybe I'll just ask API. Here we are. Okay, very good. So thanks everyone for joining, and thanks as always to API for putting this together. I understand there's a lot of people who've registered interest for this, and that's I think reflected in the quality of the panelists that will follow this brief presentation. Just for a starting point, I run international capital and capital markets for Sub-Saharan Africa for JLL. Been pretty active in the market for the last couple of years at least, and as always, it's really a pleasure to be able to talk around some of the broader trends that we see globally, as well as in the local market. I'm not going to talk for very long because I think it's more interesting to hear from our panelists. But as a starting point, it is interesting and I think quite useful, particularly where we are now with COVID and the huge dislocation that we've seen in global markets, just to highlight some of the big themes that we're seeing globally and then put that in an African context. So I'm just going to spend no more than about 10 minutes before we go to the panel discussion. So I'll prompt my friends at API just to go to the next slide, if you could. Or maybe I'll do it myself. No, here we go. Okay. So let's just start off at a top level. We're looking here at a chart which just shows what's happened to global real estate investment volumes. These are completed transactions globally, broken up by continent. You can see quite clearly how impactful COVID was for 2020 relative to 2019. Roughly, what, it was $762 billion of real estate transacted in 2020, which is a 28% fall from the previous year. It's a really significant drop. Definitely the case that there was a bit of a rebound in the final quarter, and actually the final quarter of the year really helped to restore sort of the global balance. I think $267 billion transacted in the final quarter, which made up about 35% of all year's volumes. Absolutely the case that there was a bit of a rebound in the Americas, with a 85% jump up in Q4 versus Q3 at around $118 billion. So pretty significant decline. Recovery to an extent coming in the final quarter of the year. If we go to the next slide. When you look at the way that capital is behaving, what are the asset classes that are most of interest? Certainly the case that COVID has accelerated that shift towards logistics and living. Their total market share, or their share of capital markets activity, was up 22% since 2010. It's as you can see the trend there, that logistics and living component is eating away at the retail component, and retail is no longer the sort of dominant asset class in developed markets. Obviously, in an African context, the dynamics there are different. I mean, certainly, retail is a dominant asset class in South Africa. It's 40% or so of all commercial real estate, and that feeds into the sort of dominance of retail that concerns the narrative in sub-Saharan Africa. Where logistics has and living and broadly speaking alternative asset classes have become more dominant in the developed market space, it hasn't really been the case in sub-Saharan Africa, and it's still a challenge for us. And I would say that's also the case for South Africa. If we could do the next slide. How are offices behaving? If you look at this slide, it shows the net absorption levels. This is JLL data. Clearly, you can see that net absorption dropped hugely through 2020. Each quarter, the low that we experienced in 2020 is, it's sort of a record low in terms of that decline in net absorption. Over almost 6 million square meters of office space was lost over the course of the year, and that was most pronounced, and you can just about see it here, that was most pronounced in the US in Q4, with 3.8 million square meters of office space being lost. What's interesting is if you look at Europe and Asia, and perhaps this gives us some hope, is that there was a positive trend in net absorption coming out of the back end of the year. So some evidence of a recovery and some evidence of growth once COVID was sort of getting slightly more under control. We go to the next slide. Retail, this is not that surprising when you look at the footfall dynamics across our sort of key big markets. We're roughly at a footfall of 70 to 90% of pre-COVID levels. It definitely sort of bottomed out, and obviously the markets that have been hit the hardest are those that have had the tightest and heaviest lockdown. I think in the African context, it's less dramatic. It'll be interesting to hear what the panel has to say about this, but we've seen plenty of evidence to suggest that retail, particularly in the West African market, has been holding up better perhaps than we've seen in developed markets for good quality assets, and that's perhaps because of the lack of stringency on lockdowns. If we go to the next slide. The logistics narrative is, of course, the complete opposite, and I think this is something that we certainly see it in the South African market. I think we'd see it more in the sub-Saharan African space if there was more logistics stock to play with. I think what's interesting is the dominance of, when you look at that growth in leasing activity, net absorption in the US, or gross leasing activity in Europe, or net absorption as we have it here in Asia Pac. The trend is very much the same, that all of these numbers are being propped up by e-commerce and e-fulfillment. E-commerce accounted for e-commerce and e-fulfillment accounted for 16% of total leasing activity in the US, and 22% of leasing activity in Europe, which is a doubling on the previous year. In the UK, which is Europe's most mature e-commerce market, online retail accounted for 42% of all space that was transacted in 2020. Now, in the African context, it's a very different dynamic. Certainly in South Africa, where there's more, there is more of a market for retail and e-commerce and e-fulfillment, still very much behind these European and US and Asia Pac levels. It certainly seems to be the case that rural township retail, convenience retail, does have that buffer against this threat of e-commerce and e-fulfillment for a number of reasons, and appears to have been a relatively stable asset class. I think there are obviously more challenges in the larger sort of super regional malls in South Africa in particular, but that may also be because of an oversupply. In terms of sort of looking a little bit more closely at deal flow, I think there's a couple of interesting dynamics for sub-Saharan Africa. The first is that there is really no correlation between the trends that we see in Europe and the trends that we see in Africa. That huge wall of liquidity which has gone into European or global real estate as a function of, well, as a function of liquidity, function of low interest rates, just hasn't happened. If anything, the trend has been sort of downhill for the last 4 or 5 years. There is activity, but it's extremely selective, and that activity tends to be focused in South Africa, but also focused in traditional asset classes. And if you look at the divide between South Africa and the rest of Africa, South Africa does remain the dominant player in terms of volumes, obviously because it's a larger market. But there has been over the last couple of years, there's certainly been quite a significant pickup in activity as some of the larger regional funds look to consolidate their positions. So obviously Grit have been active, and GAP, Growth Point Investec, or Lango Real Estate, as we now call them, have been extremely active, obviously through 2019 and 2020, which has helped to prop up regional volumes. Had I put 2021 volumes in here, you would see that about 70% of it is hotels, thanks to the large Casada Accor Invest deal that closed in the first quarter of this year. One of the big trends to watch out for, and it does have an impact on sub-Saharan Africa, is that switching of strategies from the biggest sort of liquidity source in the region, which is South Africa. South African money is just not flowing into Europe. It hasn't been through 2019, and it hasn't been through 2020. Europe has gone from a $4 billion market to roughly a $400 million market. Reason being is obviously that South Africans are focusing on the domestic strategies. There is definitely a rotation out of non-core. The impact on sub-Saharan Africa is that there is a lot of product in the market. If you shopping centers and anything really in West Africa in particular that is not part of that narrative, there's quite a willing case for rotation out of that. So South Africa has become significantly less dominant, not just in Europe, but also in the South African space. There are pockets of exception, of course, particularly in pension funds. As we go into pension funds, what's also interesting is that the liquidity, one of the global trends that we've seen is that private capital has become much more active, but slowly, that big wall of institutional liquidity has started to come it was a little bit cautious through 2020, but then started to come back to the market in the final quarter of last year. In Africa, sub-Saharan Africa at least, that domestic liquidity source hasn't really been tapped. The pension funds in Nigeria, if you calculate pension funds, if you adjust pension fund investments across African countries to the 10% threshold that is typical in the US, for example, and where Europe is going, it releases quite a lot of liquidity. Nigeria, we reckon there's about $2 billion of liquidity which could flow into real estate if they got to that 10% allocation. Markets like Kenya, there's already quite a high allocation to real estate, but it's generally speaking in direct space. And often not a huge amount of attention is paid to it. So, I think if there's an argument to switch that liquidity, to diversify it away from direct ownership into REITs and D-REITs or I-REITs in Kenya in particular, there's again another chunk of liquidity which could be used to underpin that domestic market. Where we've been really active through last year is in domestic capital sources, particularly in markets like Nigeria. So we still argue that pension funds can underpin regional liquidity. The other case, which I think is, before I finish, is important to make, is that the fundamental case for Africa, and I think this kind of gets lost, is around African urbanization. I'm not a huge fan of the concept of the demographic dividend in Africa. But if you look at the drive towards urbanization globally, no question, Africa is very much at the epicenter of global urbanization. 220 million Africans living in cities in 2018. We expect that to grow to 370 million in 2035, which is a rate of growth that is very much over between 2020 and 2035. That's a rate of growth which is very much in line with what we see in China in terms of GDP, urban GDP. So it's a very the argument for growth, even though there's volatility, is very much there and is concentrated in metros. Do the next slide. This is just a final slide because I think it's always worth reflecting on. You know, there is a strong correlation between transparency. This is a common JLL slide. We like to be able to compare transparency levels across all the countries we work in real estate. We have definitely noticed a trend in Africa over the course of the last couple of years. These numbers came out at the beginning of, or the midway through 2020. This is a ranking system where we look at many factors such as access to data, enforcement, service providers, regulation, all these kind of areas. It's absolutely clear that South Africa seems to be taking a step back. You know, it seems to be South Africa is not accelerating to European levels, rather it's dropping. A lot of that is the issues around the listed property space. Sub-Saharan Africa, yeah, I mean, it's making progress. You know, there's definitely progress in the areas of prop tech and land registry. And so it's sort of plateauing out. We're not seeing huge advancements, but we are seeing a plateauing out. And I think if that can remain stable over the course of the next couple of years, that is a strong motivator to pull liquidity in from those capital sources. You know, still there's a lot of space to go. I mean, only really Kenya, Botswana, and Mauritius are challenging for a level of transparency that is anywhere approaching emerging European levels, but it is progress. And I think that's at least my 10 minutes up. Yeah, so I think we can probably get on to our panel. Okay, I think we have everyone. Fine, I get to do the introductions, so I will go from left to right. So as you can read who everyone is, but why not say it? David, it's David Lashbrook from Momentum, from Maref is here. Ilaria Benucci, well known to the market from CDC, is here. Nii Adelier from Standard Bank, head of regional finance, is here. And obviously Bronwyn Knight from Grit. So between us, we've got debt, we've got equity, we've got development, we've got DFIs, we've got what else am I missing? Alternatives, we've got core asset classes. So I think there's nothing that we can't cover. We're going to talk for about 40 minutes or so, and then we will open up to questions. Kafir has outlined you can ask questions, and they will come through to me, and then I can throw those into the mix as well. So. Why don't we start? Let me start with a kind of obvious question, because I think a lot of the numbers that I was talking through in my presentation pointed to the impact of COVID. You know, and COVID has changed. It's changed the way that the real estate market is perceived. It's changed the way that the real estate market is behaving. There is a difference in behavior, I think, between sub-Saharan Africa and developed markets. So I think the obvious question is how real estate companies are changing their strategies, perhaps as a function of COVID, perhaps that's organic. And is there a shift? You know, do we see those shifts that we've seen in developed markets in Africa as we go through 2021 and perhaps into 2022 and beyond? Why don't we start with, let's start with Bronwyn. I think that's a nice question for you. Maybe run us through some of the strategic, the strategy for Grit and what you're seeing in the market.
Thanks, Tom. I just want to check that you can hear me okay. Yeah, perfect. So thanks, Tom, and it's good to see everybody again. It would be nice to see you all in person at some stage, but we live in hope. So just from our side, I think it is interesting because, there were certain, as you mentioned, certain market conditions and aspects to real estate that were pre-COVID, which you have to be careful that doesn't get caught up in the COVID debate. So there were aspects around even us at Grit that were looking at our business saying sort of being multi-geography, multi-asset class. Where did we see the ability to continue that model, but on a sustainable basis and being able to service a magnitude of countries and asset classes? So we were already deliberating around the retail side of the business, and really believing that unless you're a specialist retail business, possibly retail wasn't for us. And basically what we've seen over COVID, so I always chuckle with the team because I think when you have cracks in your business model, you can have cracks in life. One thing COVID did was bring those cracks to the forefront and expose them immediately when ultimately they could have been exposed in 2, 3, 4 years' time. So, COVID has given us, I think, a good opportunity if you've taken it to really shake up your business model. And what it's shown us is that, when you are managing a diverse portfolio across emerging markets, there's certain parameters or certain key aspects. And what we've seen is that, one, every country or government has behaved differently. So that's been interesting to pan itself out. But the asset classes, which constitutes about 52% of Grit's portfolio, which is offices, light industrial, and corporate accommodation. So as you know, we are a major service provider to American Embassy. That is continued business as usual. And maybe it's not just because of the asset classes, maybe it's the countries it's found itself in, different behaviors of lockdown, what that lockdown has meant, infrastructure in those countries. So like Mozambique, people stayed at home for a very short period of time, but we're very keen to get back to the infrastructure within their relevant offices, which is different to what you've seen out of developed markets. So what we've seen is that our business model pre-COVID, which we wanting to push around single tenanted, long-term lease, a lot of more American embassy type work, has just run to be more true over the COVID period. And then the other thing which has been interesting to see is historically, especially myself, has been so quick to jump on an aeroplane and go everywhere across Africa. And my head office management team has done the same. And we've actually had to leave our teams to do business in country. And that has been an interesting one for us. So we all talk about having infrastructure in these countries, but it was probably really shown up is that how true is your infrastructure in these countries when you can't jump on an aeroplane. So we've really had to spend a lot more time mobilizing, making sure that people in country can actually make the relevant decisions. We can't jump on a plane. So the actual infrastructure change to the business, what we knew was there, we've had to bulk up even more. And then we obviously speak about hospitality in our business, and obviously we've got the retail element. But what it means, life after COVID or life surviving with COVID, whatever you want to call it nowadays, is that we are really going to be focused around certain asset classes. That's pre-COVID decision-making as well as what we've seen during COVID. And we've also had to recognize the fact that some countries have had distress, not just COVID distress, because I think it's been easy to blame COVID for everything. I think that's also quite an easy payoff line. But countries like Zambia, from a macro perspective, are hugely challenging. And we've had to really look at our investment strategy for those particular countries. And it's COVID aside, it's just going down to the fundamental and the macros of that particular country. So, I think even for our audience, we have to be so careful that we're not just pinning everything on COVID and everything is going to resuscitate itself once we have this vaccine that rolls out. And it's about being able to make those really serious decisions about not just asset classes, but countries of investment as well. Tom, I think you are on silent.
I am on. Well done.
Yeah.
I think it's very interesting the point that you make on the way that we just run our businesses. I mean, we obviously a year and a bit of now not traveling. We actually had our best year ever in Nigeria last year. Maybe that's a function of me not being there. I think there's a follow-up question for Ilaria. Correct me if I'm wrong, but I think CDC, you've always been keen to get into that housing, affordable housing space and into these areas of where, where you've seen a lot of growth in more developed markets. And I'm wondering how, following on from Bronwyn's point, how you're seeing that in terms of CDC strategy. Are you finding those opportunities?
Well, it's quite interesting because almost by default, the asset classes that have best performed are the asset classes I'm after. So we were looking before, it was this logistics and living, right? And what I call business infrastructure, which is logistics, is hotels, if you like, as well. So enabler for economic growth. And on the other hand, you have, of course, what I call social infrastructure, which is affordable housing, student housing, and these are exactly the pillars of CDC strategy in real estate. And again, these assets, and when I talk about affordable housing, what we're looking most are rental platforms, because I think that's the way you can actually reach scale, because otherwise is 200, 300 units. That's not the way you're going to make a change on a market, but through rental platform you can. And we've been focusing exactly on this sector. So no, I'm not changing my strategy, because my strategy was the one that proved more resilient. The asset classes were more resilient, if not better. And so, I mean, in Africa, as you know, we have the African logistic properties, which we are expanding now in East Africa. Not specific to Africa, we just closed last week a large investment in logistics in India. And in housing, we are getting close to an important transaction, which is in low cost. Again, is low cost housing, is in South Africa. But anyway, we are working towards this kind. We are looking at very interesting student accommodation. So I think that this is the focus that we are taking like now. The only additional strategy I will look for, but this is very much linked to, if you like, climate change, right? So the question is, would we have distressed assets coming to market, and would that be an opportunity for acquisition with retrofit? So retrofit to EDGE standards, to better environmental standards. Would that be enough for us to consider? Because normally we don't, as you know, we tend to do more development rather than acquisition. But the climate change aspect is getting more and more relevant and important for us, and therefore the question is, can we think about alternative strategies? Too early to say, but would be interesting to look into that as well.
That's actually. I was going to ask you about the ability to capture that holy grail of building a Pan-African logistics strategy. It is so difficult. But then you mentioned ESG, and I can't ignore that. So do you think, when you look at that question around retrofitting, around acknowledging these ESG components, particularly the E, what's your sense, Ilaria, for Africa? Do you think, with Europe making big strides with EU taxonomy, do you take that sort of, sitting in Europe, do you take that and then are you thinking increasingly about applying those strategies to your African business, or is it a bit, how core is it?
It's early days. As you know, most of the new building that we back and develop, we develop them to EDGE standards, right? So, but this is the new building, right? Retrofit, the reality is in Africa has never been done. So it is very challenging. I think we should strive to make it happen, but we've been talking to IFC, because they're behind the EDGE certification and whatever, and they're trying to push for retrofit in hotels in particular, but they're looking at Asia, not Africa. We want to focus on Africa, because of course that's where I'm interested in investing. I think we should promote this kind of strategy. It's very important. It's very important, very relevant.
David, if I could ask you, I want to get down to a couple of points I think have been raised already around the challenges in these markets, and whether this is a COVID question or perennial issue, but it's particularly to do with how actually doing business in these markets, particularly West African markets, where there's a lot of volatility around currency, around liquidity, and those are kind of accentuated a little bit by the dislocation that's come through COVID. How are how is Momentum or Maref, how are you managing that narrative, and has it got worse or more challenging through the last year?
Yes, it has got worse, and it's definitely slowed down some deals. So there's two things you mentioned. The first one is depreciation, and the second one is illiquidity. Okay, and on the depreciation, it's probably more concern for your tenant, particularly if they're earning local currency, your fast-moving consumer goods type tenants. For us, we fund in dollars, so we're a dollar-based investment objective. We want to borrow in dollars, and our goal is to develop a high-quality asset for the tenant as low as possible price. And we do that by funding in dollars, borrowing dollars, because your interest rates are cheaper, and our tenant will know upfront what that rental is going to be, because our in-house developer, Eris Property Group, they'll underwrite the capital cost. So we agree even before we break ground, you know what your starting rental is, 18, 24 months when we open. They know that. They know what the escalation is. They know what their profile is. But the challenge is that it's in dollars. So it's fine if you're an oil-based company, financial services, or even the hospitality industry where things are typically billed in dollars. But the challenge comes is when you're earning local currency, and that's where the big pushback comes. So if you're looking at a manufacturing facility or anything where it's someone selling in local, that's where the big challenge comes. And we do have projects in our pipeline which are both dollar-based tenants and also local currency-based tenants. On the local currency side, what we've done is we're looking at potentially exiting earlier. So we are a development fund. So unlike GRIP, we're not an evergreen. We do ultimately have to exit our assets. So we're looking at shorter time horizons. So providing a development funding and then exiting perhaps at completion. And we can maybe exit to a local institution who's happy to take on a lease that's not dollar-based at all. So that's one way that we can potentially get around it. But it is a challenge. It's definitely slowed down deals. But just one other point to make is that rental's typically about 4% of turnover. So even if your currency depreciates by 10%, that's a 0.4% hit to your bottom line. So I know CFOs are always of tenants. They never ever want to sign a dollar-based lease. But if we can produce a rental that's perhaps 5 or 10% cheaper and a lower escalation at starting rates, it's worth considering, absolutely, because you come from a much lower base. So that's also something to consider.
I mean, maybe that is a follow-up question for you. With your two offices in Accra, that strikes me as buildings in Accra. That strikes me as a market that's been relatively resilient from the office side. Maybe that lines to what Bronwyn was talking about with the nature of the way that people are going back to the office in these markets. I don't know. How do you feel? I mean, how are you doing there on just keeping your rents sustained in particularly?
Bronwyn actually brought up a very good point at the start when she said there were pre-existing conditions before COVID. And Accra is a prime example of that. There was an oversupply, and like in Nairobi, like in Lagos, even before COVID, from probably the peak in 2016 of the oil prices and commodities, and that's come down. So how are we doing there? I think what we've seen is we've seen a rotation. One thing that COVID has done is that it's made tenants appreciate quality accommodation. So if you've got A-grade accommodation, and now suddenly people are forced to work at home, they haven't got 24/7 electricity, they haven't got 24/7 Wi-Fi, they haven't got aircon, they're not comfortable at home and they're not productive. And we've actually seen that with some tenants coming to us now because they value that. And before, they would be willing to take a grade B and pay maybe $6 a square meter cheaper. Now they're actually saying, no, you actually need that space. So that has been one thing that's been a positive for us. In terms of our rentals, I mean, the market, when we put these projects together, I mean, the market was probably 15% higher than what we're renting space for now. So it was coming down anyway because of that supply-demand imbalance. I think it's now settled. And perhaps we've got a bit of a tailwind. I think certainly the providers of A-grade, we've got two of the newest buildings in Accra, and they've got all the top facilities and lots of parking. So I think very, very attractive to tenants.
Well, it certainly seems to be the case that in developed markets, at least, there has been a lot more comfort in prime, and that differentiation between anything below prime and prime seems to have been quite clear, which is in line, I think, with what you're saying in the West Africa. Nii, tell us about the lending market. I mean, obviously, Standard Bank have always been ambitious, a dominant player in that space across sub-Saharan Africa. How have you seen the market or the environment for lending alter over the course of the last year, and how are you positioning yourself now, given some of the challenges that the other panelists have raised?
Thanks, Tom. I think the appetite remains available and remains there, but obviously there's some level of conservatism that still needs to be applied. So sort of some of the credit fundamentals you would have applied pre-COVID, you would have to sort of take a different stance at this point. You would have, between 2020 and 2021, you're seeing things ease up, and the anticipated impacts not as dramatic as you expected. So you will soften some elements, particularly for new deals or for deals that you're considering. But what's been most critical and important to us is the quality of your counterparty and your sponsors, your deal sponsors. It's quite important that you are dealing with counterparties that are long on the asset and are focused on not just on the market segments, but on the market itself. Because through that process, even though there'll be bumps on the road, you will sort of align to find sustainable solutions, at least from a debt financing point of view. So that becomes an interesting theme for us. I think Bronwyn made a point that I think applies not only to the project sponsors, but also to us as lenders. The capacity of your on-ground teams matters a lot. So in that area, the Standard Bank footprint has kind of helped us in terms of how we manage challenges and how we sort of resolved underlying problems with deals, because you are there, you can see the asset, even though you may not be able to travel internationally, you can still sort of look at things domestically, and that kind of makes it a lot of difference in coming to alignment with your borrowers or with your sponsors that you kind of deal with. So that's sort of the outlook that we're seeing. Obviously, the taps aren't fully open in terms of how new deals are being sort of put together, but you're seeing an improvement from 2020. There's an expectation of a third wave, but given what you've seen as the impact of the first wave and the second wave, the sense is that the impact on business interruption will be perhaps will not be as dramatic, at least from an Africa region's point of view. You haven't seen it as pervasive, and so that kind of gives you a positive outlook in terms of how you look at deals, what you think the impact will be, what the debt capacity impact will be, and the revenue impact, and kind of structuring around that. But ultimately, what's critical for us, and I think for many lenders, is just that you kind of double down on your key clients and support the guys that have the capital base and the focus and the resilience to be able to weather the storm.
So, in terms of your Standard Bank's position in the market, is 2021 a year for sort of consolidation and reflection, or is it a year to get out in the market and try and actively expand, would you say? And if it is the latter, with your focus on core quality product, is the product available to allow for that strategy? I think that's something that is always a challenge in our market. It's not just liquidity pools, but it is also quality of product on the debt and equity side. I think 2021 for most players in the real estate space will still be one of sort of stabilizing and some level of consolidation. You will expand, but cautiously.
So you would do deals that, you know, the market risks have been appropriately sort of mitigated, and with some, you know, with some consideration for downside risk. So we will take on new projects. We are taking on new projects. But when you talk about, you know, expanding around core, it's perhaps pursuing sort of the refinancing options of kind of established assets that have been stabilized, as well as perhaps properties that are coming onto the market, but heavily sort of de-risked, because you got to learn from the lessons of the past. I think that's the conversation you have with everyone. I mean, you could see themes of that coming through from Bronwyn and Ilara in terms of the segments that they focus on. Those segments must demonstrate resilience, and the same with us. Nobody wants to, you know, originate deals and then you're kind of in constant sort of flows of restructuring. So you kind of need things to be stabilized a bit. So that kind of still remains a focus for us and a theme for us.
I mean, I wonder if it's a question about the sort of the mindset of doing business in Africa, and obviously, you know, discussions around COVID it's a tragedy, and it's a huge challenge on a personal level. It's a tragedy, but at the same time, I think everyone who's on this panel has been in these markets long enough that quite used to dealing with events that cause significant dislocation. I mean, often it's the oil price, or it's a political instability, or it's something like that. That I wonder if it's something that comes, it's not as obviously COVID is a shock, but it's something perhaps sort of mentally we're slightly more equipped to deal with, because these markets are already so challenging.
Perhaps. I mean, I think one of the things that one of the themes that kind of drive the decisioning for us these days is, you know, sustainability. You got to look at that from, you know, from a social, user, and environmental perspective. And I think that theme, you know, is landed in a different way, and hopefully will sort of underpin future strategies in terms of how you deploy the new assets to the market, you know, how you engage the market in terms of, you know, in terms of the adoption of those products, and because it is that those characteristics that sort of allow the ability to sort of to develop resilience and to withstand pressures, whether it's COVID or currency or oil prices or, you know, or dollar liquidity in different markets. You know, it is those elements that are fundamentally critical to the survival of those assets, or sustainability of those assets.
I think I'll take a step away from that point just for now. One of the areas that, you know, where we've seen a tentative sort of activity or more engagement has been from international sources of capital starting to look at the African space, albeit, you know, it's slightly sort of Africa 101, but it's been a slightly more of a marked trend, I think, through last year. Maybe, of course, a function of pricing in Europe and in developed markets being so keen, but it is an interesting point. And I wonder a question for Bronwyn, who, you know, you've got shareholders from which are quite geographically listing in London. What's your sense of what capital is looking for in terms of an African strategy? You know, what countries, what sectors? We've already touched on this kind of move towards alternatives and or industrial or areas that are slightly more, you know, have a slightly more sustainable approach, as you said. Well, what's your sense in the market when we talk to international capital?
Yeah, so it's actually a good point there, because, you know, one of the rationale reasons that Grit did the London listing, and you would have seen in January we did the premium step up in London, and that was to diversify the share register and really access international capital equity into emerging market Africa. And over the last 2 years, our UK register has ramped up from 12% to close on 40%. So I've been in considerable discussion with these UK institutional guys, and I believe that, you know, what we've seen over COVID is actually an opportunity for Africa. So whereby a lot of these guys would have placed their money in Europe and the UK and developed markets, there's a lot more interest now to really understand emerging markets and actually diversify their portfolios. So historically, alternative investments was quite a small asset class for them, or a small consideration. And because of the returns they're now receiving, and okay, I think COVID accelerated a lot of the challenges you see in developed markets. There's a lot more conversation to say, how do we access emerging markets and how do we find companies that can provide a bridge or a conduit into Africa, which means companies that understand governance, that have gone through stringent controls around governance. I mean, we were just audited or reviewed by DFI to put money into the Grit business. And you know, they commended the team on the amount of information and transparency. And I think it's obviously a lot of it's been pushed by a London listing. But you know, what is really, really important is that I believe the money exists and I believe the money wants to come to Africa. But guys still need to see a very, very governed structure to be able to put that money in. And what we're trying to do as Grit, and obviously through the monumentous task and the process we went through to get into London, is to try and say, okay, the governance does exist and come and access Africa. The other interesting one is we're seeing different types of money. So we're seeing not just general equity money, we're seeing guys that are approaching us on different types of instruments to put into Africa, more mitigated type instruments, preferential type instruments. We're looking at guys that are very keen on co-investment opportunities. We have got groups that have approached us on specific asset classes. So they're saying, okay, we like light industrial, or we like your X paper. Is there an opportunity to co-invest? So what we're trying to do as Grit is we're trying to say, okay, the equity story is not going to just be fixed on X, which means you have to access our stock through the exchange. We're saying is, how can we diversify the platform? Because all this potential new money for Africa is good news for all of us. And I always say that's why we shouldn't actually be in competition, because if we have more success stories in Africa, these guys will want to put more money behind it ultimately, which means that there will be an offering of different types of products, et cetera, et cetera. I do think, though, it's a conversation and it's a collaboration that probably needs to be taken on a bigger scale. And I always implore on my colleagues, and even the ones that are here, and some of us are in discussions already, is that unless we're all speaking from the same hymn sheet and promoting the same types of capital, showing the more success stories, we're not going to see this money for Africa. But I'm actually quite excited, and our head of investor relations and I have spent huge amount of time. One, we can't travel, so we've actually engaged a magnitude of investors. If I say that we've probably spoken to over 100 investors over the last couple of months, I'm not exaggerating. And a lot of this is actually fresh market for Africa or increasing positions for Africa. And for me, if we can leverage off this and if we can collaborate as a platform, as a real estate platform, and that includes financiers, DFIs, co-investors, investors, private equity, listed, and we can actually sort of bring these guys to the sort of emerging market Africa story, that's where we see the success. But I actually think it's just the tip of the iceberg, to be honest. And the money does exist out there. It's just it's conservative money and might be slightly anxious money because it hasn't seen the success that people have said they're going to deliver X and they haven't really performed. So yeah, that's where we're seeing, Tom, where we're seeing the market at the moment. And as I said, I'm finding that it's all about education. I mean, it sounds ridiculous. I think I'm doing 5 different panel discussions actually just today, and that's just a broad spectrum of retail clients, new investors, guys that are looking at co-investment. I mean, we've had approaches for all sorts of things, and we need to keep talking, and we need to keep singing off the same hymn sheet around why we believe that Africa is not just resilient asset classes, but why Africa is a resilient continent for a post-COVID period.
So I guess, thanks, Robin. I think one of it's hard to disagree. I think the challenge that what I always have with clients when I talk about Africa is the availability of product and simple structures which are easy to understand and which have longevity. Whether that's the acquisition of a portfolio of existing standing assets, or that goes into the development space. And I guess the follow-up question, which is probably one for David and Ilaria, is how do we get to the stage? Like I mentioned earlier to Ilaria, that golden chalice of really easy to understand Pan-African logistics strategy. Like how do you get, from A to B? Who's going to put that product into the market? I mean, I suppose, Ilaria, you're so focused in that area and you've had success with ALP. But ALP has been 5 or 6 years, like 4 years, 5 years, 5 years. How do we accelerate that process? How do we get this product into the market, and how do we get it into a position where big sort of institutional capital sources can double down?
I know I was on mute. I think that the first question is Pan-African. Does it make sense? This is still a question to me. As in, for example, with LP, we've been successful and we hope to be even more successful in the years to come in East Africa. I wouldn't see that team replicate the very same team in, say, Nigeria or West Africa, because I mean, why we were successful? Because we had a good management which was present local, based in Nairobi, not in South Africa or somewhere else. So I think that what is more interesting perhaps is to look at different regional strategies. If you look at specific logistics, so you would have a platform for East Africa, platform from West Africa, platform for Egypt, which per se, I mean, again, I'm going very ambitious here, but I mean, just let's think big, and South Africa, where the market, of course, is already thriving, existing. So that's the deal. How do you do that? It's not, Tom, I mean, better than I do. It's much easier to build a platform if you can buy existing assets and expand on those. And unfortunately, this is not available on the market because there are a few players and they're quite local for that kind of product. So it's going to take time. I think it makes a lot of sense. Again, this is an asset class where investors, even international investor Brani would say, I'm sure there will be demand for logistics in Africa. I'm sure. But the question is that I don't see anything happening in the next 2 or 3 years. I hope to find like-minded investors and developers that we can back and build more platform. Again, my West Africa platform, Francophone platform, I mean, whatever. And maybe we can do joint venture with Great. I don't know. I mean, I'm very open in this, okay? There is no, or if they're interested in doing a specific asset class pockets within the fund. So I think that we have mental flexibility here, and this is. But again, I think it would take time, and it's not fast. Also because another point we've seen with ALP, we were expecting at the beginning that the international multinational immediately understood the advantage of paying higher rents because the efficiency of the pallets and whatever would come to you. That was not the case because it takes for a long time to make investment decision, and so we have a lot of very active e-commerce local regional players as tenants, not the PNG. So it takes time to get to market and to get the big guys to buy into the story.
David, it's always struck me that you guys are taking quite a flexible approach as well. I mean, if a deal looks interesting, you'll look at it, right? I mean, would you concur with a lot of what Ilaria was saying?
Yes, definitely. Yeah, and I mean, if you look at distribution at the moment, we'd love to. We haven't done any yet. Eris certainly have done a few in South Africa, quite a few, but we as Marif haven't done any yet, and we would absolutely love to do them. We've got a couple in the portfolio, but they can be challenging to put away. And one of the main things is the land price. If depending on the sophistication of your warehouse, if it's basically just a shed, your land price is a big portion of that, and often you've got landowners that have got expectations for the price of their land, and they won't budge on it, and it just doesn't make commercial sense to put up a warehouse. So that is one big challenge, is the availability of land. And then I think if you talk about liquidity as well, it's great what Grits are doing and seeing all this liquidity coming in, which is fantastic. And I think that chart you put up with the amount of assets that could go into the local institutional space. And if we can get the offtake, us as a development fund, a big part of our fund, because we relatively short term compared to Grit, Evergreen, a big and very important part of our return profile is getting that exit. And until the investors can see that and see the history of transactions, it's always a bit of a barrier, because people say, well, what is the exit? How are you going to exit? So that is also a challenge as well. And I think getting the local institutions involved, that'll also be a catalyst as well.
Yeah, it strikes me that's a really important point, that the way that capital is mediated is it's not much better in South Africa, actually. You could argue that the pockets of capital that do things in sub-Saharan Africa are a little bit more rational than the South African capital sources. But that central sort of consolidator of capital, like an African Blackstone or an African Brookfield or Starwood, you need that. You need that so that the money can flow from the institutions into the consolidator and then on to developments or listed or private or whatever it might be. And I think it's a very interesting point. I mean, tapping this pension fund liquidity, I put that chart up, but we've put that chart up for 5 years. Yeah. It's not that new. And it's a bit frustrating that it's hard to that space. Okay. Maybe that's a question also just to ask for Nii. I mean, looking at the debt market, I mean, how do you find the balance between between development and between standing assets? Are you finding you're having to, in all things being equal, are you going to find yourself in a position where you have to move slightly further up the risk curve in order to be able to access those strategies?
So I think, thanks, Dom. If you look at our history from Standard Bank in terms of how we built the portfolio, our debt portfolio, we're not worried about development risk in that sense. We have the internal capacities to sort of manage that risk, and we've done so. Our growth within the property market actually was through development. At the time we started financing deals, there were no ready assets in that sense. You kind of you found a good jockey, you back them. So that's not that's not a challenge, I think. I think the way we would sort of evolve in terms of, and we see the market evolving, and it's really about ensuring that some of the exuberance that may have occurred in the markets a couple of years back in terms of overestimating or oversizing either assets or the market demand is learned, and you kind of then sort of curtail project scaling and sizing to those realities. I think once those elements kind of flow through, it becomes easy to sort of dimension the risk and then sort of support that with capital, at least with debt capital. So you'll continue to see, for us, you continue to see sort of supporting existing assets and also new growth. The other reality that we've started to look at is that there is enough stock at the moment. Not as much as you would like, but there's enough to start to create portfolios. And I think that theme of portfolios is something that we are sort of driving, because what it does is that it gives flexibility both to the lender and to the counterparts as well, in terms of what they can do with capital, the ability to navigate through sort of volatilities across different markets. So as long as you can find that sort of narrative to sort of build a business case around and a financing plan around, then it starts to give you more flexibility to do deals and to do things. I mean, the typical sort of development kind of structures become quite restrictive for many operators. But then if you build a structure around sort of a portfolio that gives some flexibility, then everybody has room to maneuver and to navigate while sort of mitigating and managing risk. And that's kind of the way we kind of see the market evolving. I was trying to make a point earlier around sort of sustainability from a user and an economic perspective. We all have to demonstrate that we've learned that lesson around what is sustainable, and build projects and build deals around those sustainable features. so that from a financing point of view, you're not going through sort of upheavals every sort of now and again. And I think that for us is how the market will evolve. To Lara's point, I also don't think it will be rapid growth, because you always have to find that equilibrium and balance between addressable supply, addressable demand and supply.
Thanks, Dee. That neatly takes us to 2 o'clock, and we've definitely got time for questions from the listeners. They've been pinging through to me on my phone here, so I'm not gonna divvy these up. I'm gonna throw them to the panel, and I think if you've got a good response, you can take it. So the first question is, so do we have any concerns about inflation, and how do we see that impacting investment flows into Africa? And I think that's actually not just a question for inflation, currency-driven inflation in Africa, but I think it's also a question that leads into lower for longer rates in Europe. Is there a relative advantage in Africa? Does anyone have a particularly strong view on that question around inflation picking up, particularly perhaps in West African markets? Do we see stresses, pressures on the rents? I'm going to pick someone if none puts their hand up.
Thank you, David.
Yeah. Tom, inflation in West Africa has typically been high for quite a long time, and historically has been higher than, let's say, in East Africa. So it's something that we live to deal with. I think as a dollar-based investor, if we can get a deal that is dollar-based, we don't worry about it so much. I think that if there is a massive blowout, like a Zim type style, yes, that'll obviously be an issue for all tenants, and for the economy, and there will be a local currency depreciation. If there's a big local currency depreciation, that will absolutely hit you. I think even if you aren't entirely dollar-based, that is so it's a risk we're aware of. It's not something that's in the forefront of our minds when we invest. We are monitoring inflation levels, but it's not something that we structurally are very concerned about at the moment.
Thanks, David. Another question is, have you or your investors, obviously open to the panel, lowered return expectations in the post-COVID environment? That mythical mid-teen IRR that we always talk about. Where do you sense any changes? Do any of the panelists sense any changes in this post-COVID environment in terms of expectation?
Yeah.
No, David, go for it.
Yeah. Yes, it's on a risk. We've still got our overall function, but certainly on a risk-reward basis. Some deals when we take to investment committee are priced slightly higher, and that there's several factors in there. It might be sector, it might be country, it might be the tenant covenant. So it's all based on the individual deal. But yes, we have taken deals to investment committee at a lower rate of return. And to be totally frank with you, to obtain mid-teens IRR is hard. It's you got to work. It's very difficult to get that.
It seems that Tom left us. I agree with you, David. I think that especially US dollar IRRs in the teens are not easy to get to. And actually probably we should think more at a yield producing income portfolio, which is what Grid is doing. In principle, I wouldn't want to see less IRRs because of COVID. I mean, COVID would pass. I suppose that at the moment we have to accept the fact that previous investments, either they would take longer to stabilize, which obviously will have an impact on your exit IRR, or are not performing as you were expecting them to perform. But going forward, I don't think the structural change. I don't see the challenge are the same, right? I don't see them changing. Probably more for, again, go back to asset class. more for retail, more for offices, and less for logistics and whatever. But it depends on, I think it's difficult to generalize. So it's very much asset by asset.
Thanks, Ilaria. You managed to keep talking there whilst Mike got back onto my... I'm sure everything you said is absolutely on point.
Absolutely. We all agree.
Excellent. Well done. The question of ESG has come up a couple of times in the questions that come through to me. Ilaria, you touched on ESG, but do we think there is a market for ESG? I mean, perhaps this is the other panelists. Is there a market for ESG compliant products, or is it too early? I mean, there is an associated cost. Regulation is not. There's not so much oversight in Africa. Bronwyn's kind of nodding her head, so maybe, that's one for Bronwyn.
Yeah, thanks, Tom. And while I'm nodding my head so vigorously is, we're seeing this international sort of money that we talk about is really, for its ESG component and messaging ESG is critical. So we're working on a transaction at the moment, for example, of 2 hospitals, healthcare projects in Mauritius itself, that ideally will be backed by a DFI who has an ESG component to it. And what we're seeing is that, obviously from our governance and reporting, as Grit and London Exchange, ESG is critical for us. We've also got pension funds that invest in Grit, who've got massive ESG requirements. But the ESG component for us is very, very interesting. And where you have a real estate asset that has impact, and Ilaria and I have spoken about this for years, because we've always debated about hospitality and luxury hospitality and what that means for ESG, et cetera, et cetera. But, it's becoming more and more important to have a direct correlation around impact assets and having those part of your portfolio. Healthcare is something I've been personally very, very passionate about for a number of years. And it's been quite a tricky asset class to get off the ground. And one of the things COVID has obviously accelerated is the idea of healthcare now. And a lot of governments are happy to do structured type deals on land, et cetera, which is really, really exciting. But, for us, we see actually a major part of our business having an ESG link to it, an ESG real estate link to it. And that's why I was nodding my head so much, because there are DFIs out there that are wanting to put money behind these ESG type assets. And it's up to us as the operators, as you see here, that are able to give them products. I think, Tom, you mentioned probably at the beginning is that it's difficult to find people product, isn't it? And, it's about the proper product that speaks to these type of mandated money. So for us, it's actually a big component of the future.
I think maybe just to add to that, even from a debt financier's perspective, at least from a Standard Bank point of view, it's an important theme for us. So, we have sort of ESG type sort of funding structures that we would deploy to projects that qualify and to those of our clients that sort of elevate those themes in their businesses. I think it's too relevant for us to be able to kind of ignore. But I think perhaps where your question is going to is that is it affordable in terms of the features you kind of need to build into specific projects, and whether that is applicable to the developments that you can sort of follow through from a continental Africa perspective. And I think each sort of sponsor will sort of have to evaluate that on their own merits. But I think what Bronwyn probably is speaking to as well is the fact that you have to also sort of redefine what the ESG application and context from an African perspective. So healthcare becomes more important. It's impact investing from that perspective. Economic sustainability becomes as important as environmental sustainability, because that sort of speaks to the impact themes of the decisioning and of the environment that you are sort of operating in. And those are some of the things that we think about from a Standard Bank point of view.
Can I quickly jump in?
David, yes, absolutely.
Yeah, no, Bronwyn, very encouraged about what you said. We haven't fundraised for several years, and certainly back then, like 2015 to 2017, outside your DFIs, it was Africa 25% IRR, or yeah, you're out the door. Glad to see that that's changing. Really, really good news. And yes, we absolutely embrace DFI. ESG. Our minimum standards are IFC Edge or more. And we have done, I mean, in the construction, it's just such a great industry for recruiting people, building, creating jobs, and upscaling people as well. So, yeah, I think very, very important from an impact point of view.
Can I add a couple of points on this? One is that this additional cost, I think, is a bit of a myth, as the edge qualification actually does commercially makes sense, because at the end, the developer, the owner of the buildings or whatever, you have savings, you have energy savings, and it's pretty straightforward. So is no additional cost if you look at the overall balance sheet of a building, of a business. And secondly, I genuinely believe that an asset which would not be up to certain sustainable standards would lose value over time. And therefore, the people will be prepared going forward actually to pay a premium for something which is sustainable and is helping in climate change and things like that. So I would personally, beside my mission as DFI and whatever, I would have serious problem in backing, for commercial reasons, something which is not on the forefront on that front. Hence the new strategy of retrofit, basically.
Thanks, Laura. I think that it's a very prescient point, in the sense that I think all the evidence in European or developed markets backs that up. You know, rental growth has accelerated, leasing activity has accelerated, and capital values are, you know, pre-COVID at least, go up faster than non-ESG compliant buildings. And of course, all the liquidity supports that too. I mean, the big article in the FT today from Nuveen saying they're going to be net zero on all their buildings by 2040. That's a really big story, actually. I mean, I guess my question is, in the African space, you know, is the pressure coming from the institutional it's the capital that drives it. It's the requirements from the capital, it's the requirements from DFIs, it's the requirements from investors. And I suspect, I mean, from what everyone's saying, I think we're going in that direction, but perhaps it's not such a wholesale approach as we're seeing in the European markets. I mean, maybe that's the... we're getting quite close to the end here, so I want to finish. I've got quite a lot of questions that have come through, and I'm summarizing them into one question, which I'm going to ask each of you if you could give me a sort of sentence answer to wrap this up. I'm going to ask you what your forecasts are for this year and next year, as relates to two components, and perhaps Nii may come at this from a different angle, but do you see rents starting to stabilize, decrease or increase? Do you see capital values starting to plateau? Where's your forecast for 2021 and 2022? Maybe on your completed assets, on the assets that you hold. You can break those up by geography if you like. So maybe let's start with Bronwyn. You've got an extensive portfolio. So.
Bronwyn, you're on mute.
There we go. Thank you. Thanks, Nii. Thanks that our banker helped me there. Mm-hmm. So I think it is quite a complex question for us because we have got an expansive portfolio. And, you know, I have to be careful of the word for.
Oh, no. Do you want me to pick up quickly?
Yeah. Tom, you're on mute as well.
Yeah.
Okay, David, you crack on. Thank you.
One sentence. I think they've stabilized, and it's to go back to a point. Even pre-COVID conditions, again, it was falling already, and you know the rentals we're signing up at the moment, they have plateaued over the last year, and I think we're starting to see a bit of demand. So I think they'll stabilize for a while, because your key, I'm just really talking key office markets at the moment, but the key office markets are still oversupplied. But I think people will value certainly A-grade space going forward. That's what we're seeing. So I think plateau for a while until that all works out the system, and the economies. I mean, the economies are going to grow, and then we'll see some. But yeah, I think certainly for the next year or two, they'll probably stay where they are.
Thanks, David. Ilaria, what's your forecast? You're on mute.
Can you imagine still after 1 year of this, we still
At least you
mute and forget about it. I agree with David, as in reflection of specific markets. I mean, oversupply of offices in Nigeria, just to say something which is obviously well known. So that is a structural issue, it's not a COVID issue. So I do see stabilization, and I don't see really an increase in 2021 or 2022. I think that would plateau and stay where they are. I have a bit more hope for logistics. Obviously, I mean, it's no surprise for anybody. But again, I don't see an immediate increase in rents. I just see stabilization, probably a big compression in cap rates, because it's a much more sought after kind of asset. But otherwise, structure will remain same.
Thanks, Larry. Bronwyn has moved around her kitchen again and is back. So, Bronwyn, what answer were you formulating?
Thanks, Tom. Apologies. We've got Wi-Fi issues in Mauritius under lockdown here. So I think, yeah, from our side, as I've mentioned, we've got quite a diverse portfolio, and the word forecast becomes a bit of a swear word when you're a London-listed business. But I think from our side, we are really, and I think maybe Ilaria was saying it as I dialed back in, is actually the history, and over COVID, we've actually seen relatively little valuation impact on light industrial and corporate accommodation specifically. So, those will continue, we believe, to be quite stable. Hospitality is a bit of an anomaly, and it's already dependent when we get back to life as normal from a tourism perspective. And I still see further challenges around retail specifically. Our portfolio in itself, we've taken quite a substantial valuation hit on retail, but there's going to be a lot more that needs to be assessed from a retail perspective going forward. But again, the diversification, the country diversification, we're seeing some countries come out of it relatively quickly, other countries not. So again, the whole grid model around diversification is what we believe is quite important, because you will have these things in waves going forward.
Thanks, Bronwyn. And Nee, you could answer it in a different way. Maybe where do you see dollar lending rates next year?
Yeah. I mean, I think there's consensus. I think for many of the markets pre-COVID, there was already some rebasing of rents, and you didn't see COVID sort of erode that further. We thought, I mean, there was concern that it would, but it kind of stabilized. So if you look at it from the geographies, the markets where you are seeing some weakness, probably some of the East African markets, maybe Kenya, because of some of the macro issues there. Obviously, we talked about Zambia. Those those are less related to COVID and more related to the macro fundamentals of those markets. If you talk about sectors, even in the office space, we found that to be relatively resilient for assets that have been sort of stabilized, or we're moving towards the stabilization phase, despite some oversupply in some of the markets. I think what you tend to find is that tenants remain somewhat sticky, and it kind of speaks to David's viewpoint on the office space. In retail, the largest stabilized retail assets still kind of remain relative. I mean, depending on which economies they're present in, sort of remain relatively sort of stable as well. But the newer ones will go through some pressure. Will go through further pressure. The more convenience retail, I think those have also demonstrated some resilience and would, both in a rental format and a demand format, or a demand form rather. Your industrials have been quite resilient, but also I think there's not a massive supply of that across the different markets. So that also kind of keeps that demand supply balance quite tight. And then you're seeing the evolution of sort of new sort of alternative asset classes. Bronwyn spoke about medical facilities. You're seeing sort of telecom sort of accommodation and corporate accommodation. Those will also continue to sort of remain where they are. I agree with everyone in the sense that you would probably see things sort of remaining relatively flat for the next 2 years. And then you kind of see new shoots of projects sort of picking up. And hopefully with a lot more sort of sustainable features, financially sustainable features built into them from a rental point of view. And then the market sort of would evolve. We also see new sources of capital into those markets, and so that those may drive certain things, may drive certain behaviors as well. But that probably summarizes it from our side.
Great, thanks, Nii, and thanks. I think this will conclude at this point. So thank you to all the panelists for your very honest responses to the questions, very pragmatic and positive answers at not an easy time. So we appreciate that. I don't know if I'm going to hand over to Kithia now to wrap things up, but thanks again for the panelists and thanks for API for pulling this together.
Thanks, Tom. Thanks, Kithia. Thanks, Tom.
Yeah, thank you to all the panelists. Thank you, Tom. Really provides a great perspective of what we're looking forward to in 2021 and beyond, and some also positive green shoots from the discussion as well. I just think that we tend to just get fixated on what's happening globally, but I think the context of what's happening on the continent is more nuanced and different. And it's definitely going to be an interesting year, but the underlying trends that were happening are continuing to happen, or albeit accelerated. So once again, thank you to everyone on the panel. Tom, great moderating as always. And we hope to touch base with everyone soon on our next panels and sessions. And as Bronwyn said, hopefully we meet in person sooner rather than later. So great, thank you everyone, and we'll make the episode available within the next week. So thanks for everyone for joining and shooting through your questions. Thank you.
Thank you very much. Bye-bye.
Everyone, bye-bye.
Thank you. Bye.